What exactly are stocks? Why should you buy them? When should you buy them? And why do you even need to know about them? How's it going, everyone? My name is Dan. You can call me Malone. And listen, the number of people who are investing on the stock market today in 2020 is growing rapidly. To use Robinhood as an example, which is one of the most popular trading apps on the market at the moment, the number of users over there rose from 1 million in 2016 to 13 million in 2020. In fact, the company stated recently on Twitter that the goal was to make finance as culturally relevant as music, sports, and the arts. The recent hype towards investing culture is great, and I'm absolutely all for a greater interest in finance and business as a whole, and we've definitely seen an increase in finance content across YouTube, Instagram, and TikTok. But I do think it remains important that you on the other side of the screen realizes that your investment success will be largely influenced by the level of understanding that you personally have of the investments that you're putting your money into and of the stock market as a whole. And that's why today I'm going to discuss 5 important talking points when it comes to stocks. But before we begin, as always, if I could ask you to drop a like in the video, it really does help me out a lot as YouTube pushes the video to more people based on the number of likes that it gets. And if you are new around here, please do consider hitting that red button and subscribing to the YouTube channel. It would be great to have you back again in the future on other videos. And without further ado, let's get started. So we're going to start off by looking at what exactly a stock is. A stock, otherwise known as an equity, represents an ownership interest in the given company in which you purchase the stock. In effect, what that really means is that when you purchase a stock or equity in a company, you are effectively becoming an owner of that company. And to a lot of people, that might seem like a far-fetched idea that buying 1 or 2 shares in a company such as Facebook can actually make you an owner of the company. But that is what a stock is. It entitles you to an ownership interest in the company. So when all is said and done, you as a shareholder of the company are entitled to a proportion of the company's net assets and earnings relative to the shareholding or proportionate shareholding that you personally hold. Honestly, that really is one of the coolest parts of investing. By buying shares in these companies, you are effectively becoming an owner of the company and putting yourself in the middle of their commercial landscape and commercial ecosystem. By virtue of having an interest in these companies, everything that they do suddenly becomes way more interesting and way more relevant to you, and you're actually more likely to read up on business news and take an interest in the subject. So the first key talking point around stocks I want to discuss today is, why do companies issue stocks in the first place? Because if you think about it, why would any privately ran company who's doing well want to issue stocks into the free market and reduce the proportionate holdings of their private owners? It doesn't really make sense at a first glance, because all they're doing is reducing their entitlement to the net assets and earnings of the company. But the primary reason that companies issue stocks in the first place is to raise finance or money in order to expand the operations and growth of the company itself. Really, issuing stocks or equity into the market is just another way that a company can have access to cash flow in order to expand the business, as I previously mentioned. And if we take a look at the sources of finance that a company has with respects to gaining access to cash flow, it's typically made up of debt, which represents loans from the bank, funds from venture capitalists, which typically only applies to startup companies, and utilizing the free cash flow or operating cash flow of the business as it earns money and generates income for its shareholders and also for its internal operations to expand and grow. So therefore, by adding equity financing to this list, the company is effectively adding another avenue by which it can obtain financing to grow the business. The second key talking point I want to discuss is, what are the reasons to hold stocks in the first place? And look, theoretically, there might be an infinite number of reasons as to why someone might want to invest in stocks in the first place, but in my opinion, it really boils down to 2 key reasons. The first reason is known as capital appreciation. Capital appreciation represents the increase in value of your shares over time. The very large and very rapid capital appreciation of technology stocks such as Facebook, Apple, Amazon, Netflix, Google, and Tesla as of late are one of the main reasons why so many people are getting into the stock market in 2020. Everybody sees these massive gains that people on Reddit are making and really don't want to miss out on the opportunity to buy in and realize some of those gains. But generally speaking, even though I don't encourage a short-term mindset when it comes to investing, one of the principal benefits of investing your money in the stock market is the capital appreciation or increase in value associated with the stocks that you buy. However, there is always two sides to the same coin, and of course the value of your investments can go down over time, but you can minimize the likelihood of this happening by doing correct research, buying at the right price, and not overpaying for any investments that you purchase. I think it's very important that you're aware that losses in the stock market and losses when it comes to investing are inevitable. They are going to happen, and really you shouldn't be getting involved in the stock market in the first place if you aren't willing to deal with those red days where your stocks or investment portfolio as a whole is down 5, 10 or 15% and you're panicking and you're thinking to yourself, oh my god, I need to sell right now, get me out. But really this is all cyclical. 2020 has been a crazy year for volatility, and going in with a long-term mindset to investing, going in with a long-term mindset to capital appreciation will generally get you through some of the tougher short-term times. So really, doing your business research, having a well thought out investment plan, and carrying out any necessary due diligence are steps in the right direction to realizing that tasty capital appreciation, which is one of the main reasons for holding stocks in the first place. The second reason is dividends. Dividends are effectively the payments or rewards that you will receive from a company by virtue of holding a share in said company. What's important to realize when investing in stocks for the first time is that some companies pay dividends and some companies don't pay dividends. You might be asking yourself, do all companies pay the same dividends? Do companies operating in the same sectors pay the same dividends? And the answer to that question is no. The dividend that you receive is going to vary from company to company, but one of the best ways to see what bang for your buck that you're getting is to figure out what is known as the dividend yield of a particular stock. Dividend yield is simply calculated as the total yearly dividend for a particular company over the share price of that company. And comparing yields between companies operating in similar sectors can be one of the best ways to determine what bang for your buck that you're getting by choosing one company over another. However, just because a company has a high dividend yield does not mean that you should be running to put all your cash into that company. It typically has a high yield for a good reason. All in all, receiving dividends from companies is a great way to expand your own personal income streams and is definitely one of the more attractive reasons to get involved in the stock market in the first place. The third key talking point I want to discuss is how to know which stocks are cheap or expensive and when to buy or sell. What's really important to understand with respect to a given share price for a company is that the share price that you are seeing is a representation of the market's outlook or prospects for a given company in terms of earnings potential, future dividends, whatever it may be, sometime in the future. Therefore, effectively, the share price today is the present or current value of the future cash flows of the company. And this is then presented on a per share basis and translated into a share price which we, the investors, would pay today in order to gain access to those future cash flows. But of course, the future is not certain. We don't know what's going to happen in the future, and therefore a lot of assumptions are made around growth rates, increases in growth rates around earnings, projected dividend payments in the future, etc., etc. And this is one of the main reasons why the stock market can get out of hand sometimes, because if we don't have a good grasp on our assumptions around growth, or our assumptions around growth are just a bit too ridiculous, then the actual share price that's going to be reflected on the stock market is going to be heavily inflated, and we're going to have super positive expectations for the given company in the future. And what ends up happening is that even if that company does increase its earnings and it does increase its dividend payouts to its shareholders, the market will actually lower the value of the shares if the rate at which those earnings or dividends payments have increased are lower than the initial expectations that originally drove the original share price. And hopefully you can see that the higher the expectation associated with a particular assumption around growth, then the higher the risk is associated with that share. Jeff Bezos of Amazon once famously said in an interview that the stock is not the company and the company is not the stock. He was referring to the internet.com bubble, which saw the Amazon share price fall from over $100 a share down to $6 a share, all the while the actual internal business processes of Amazon were improving at record rates, therefore showing the miscorrelation between the share price and the actual underlying business. And this is a general concept that's really important to remember when it comes to stocks on the stock market. Just because a share price is going up does not mean that the actual underlying business or underlying company is improving. It could just mean that the market's expectations for the future are very, very high, which are driving the present value or current value of the share price today. And likewise, just because a share price is going down does not mean that the actual internal business processes of the underlying business or company are failing or worsening. It just means that that company could potentially have fallen out of favor with the stock market in terms of future expectations, even though everything is looking good from the inside. So having considered all of that information, how do you go about determining which companies and which stocks are cheap and which are expensive? Let me start by saying that just because one company has a higher share price than another company does not make it worse of a deal than the lower priced company. For example, a company who is priced at 1,000 euros a share might be an absolute bargain when you consider its earnings potential, strength of its management team, its future prospects, etc., as compared to a company who is priced at 50 euro a share, who has very, very little prospects in the future, is highly leveraged, and is generally a risky investment. But one of the easiest ways you can determine which stocks are cheap and which stocks are expensive relative to the actual future earnings potential of a company is by Googling the company name followed by PE ratio, or price to earnings ratio. What this ratio will effectively tell you is what is the relationship between the current share price as listed on the stock market today and the current year earnings results for the company in question. For example, if you had a company whose shares were trading at 10 euro per share and they had current earnings results of 2 euro per share, then the price to earnings ratio of that company would be 5, being 10 euro share price divided by 2 euro earnings per share. And what this effectively means is that you're paying 5 euros for every 1 euro of earnings in that company. And this can be retranslated into you effectively saying that it would take 5 years at the current earnings level to recoup your initial investment if the company decided to distribute 100% of its earnings each year for the next 5 years. So therefore, the higher the PE ratio is, the higher the market's expectations are for future growth, and subsequently the higher the risk is associated with that given share. And by asking yourself that question of how much am I paying for this share, you kind of are already answering the question as to what price you should buy in at and what price you should sell at. We're saying that if the PE ratio is quite reasonable considering the facts and circumstances surrounding the company, then we would likely go ahead and buy the share. And if at any time during our period of holding that share the PE ratio becomes a little too unreasonable, we've made a lot of gains on this share, then we might actually consider taking some profits by going ahead and selling that share. Ultimately, one of the worst things that can happen and one of the worst feelings in the world is when you make a good investment, you buy it at a reasonable price, the price has gone up, but now you're just being a little bit too greedy and you're afraid of taking profits because you're worried that the price will go up even more, and then you end up losing profits because the price goes down. The market cops on that the PE ratio is too high, and now you've missed your opportunity to sell. The fourth key talking point I want to discuss has to do with the idea of value investing versus speculation. For the purposes of this talking point, I'll be referring a lot to this book right here, which is The Intelligent Investor by Benjamin Graham. This book is often considered as the Bible when it comes to the concept of value investing, and I would recommend everyone watching this video go pick up a copy, give it a read for yourself, and you'll learn so much when it comes to the stock market and investing. The point that I want to get across in this section is that stocks are typically bought on the basis of either value or speculation. So I want to start off by first talking about value investing. A key concept of value investing is that the future value of every investment is a function of the price that you pay for it today. What this means means in layman's terms is that the higher the price you pay for a stock, the lower your return will be. And that's why I emphasized earlier on in the video that it's critical that you always question how much you're willing to pay for a stock, because if you don't, your returns or lack thereof may be disappointing. And furthermore, as the book reiterates, someone who is attuned to value and value investing realizes that as the price of a stock increases, it becomes more risky, not less. And they also realize that as the price of a stock is falling, it becomes more attractive, not more risky. And remember, for those of us who are involved in the stock market and investing game with a long-term mindset, we shouldn't be getting upset or mad at short-term decreases in value of the actual stocks. The reason for this is because we are being given the opportunity to buy more stocks and increase our holding in our favorite companies at a cheaper price, which is a fantastic deal. And the value of a deal such as that only increases the more that decision to invest in the first place was based on long-term thinking and long-term decision making. When you buy a stock on the basis of value, you typically have a lot of evidence or reasoning underpinning your actual investment decision. On the other hand, when you buy a stock on the basis of speculation, you're effectively saying that you're buying that stock with the anticipation of the share price increasing, and that's really the only sort of support you have for the actual investment decision. Someone who is typically used to buying stocks on the basis of speculation might get very excited when they see a stock jump 50, 60, 70, 80% in 1 or 2 days. However, they might not necessarily consider that that actually means that that stock has gotten significantly riskier over those 1 or 2 days, even if they do have the potential to make a quick gain over the next trading day or two. Remember, when you're investing, your goal should be to achieve adequate, not exceptional returns. You literally just want to beat the return that you would have gotten if that money was sitting in your current bank account, which is a very, very low percentage. So if you can achieve any gains by way of capital appreciation or dividends while also keeping your risk in check, that to me is a win-win situation that can't really be achieved by way of speculation. The fifth and final key talking point I want to discuss is where and how stocks can be bought. Nowadays, it is relatively straightforward when it comes to actually going ahead and buying any particular stock that you might be interested in. All it takes is for you to set up an account with any given online stockbroker. For me personally, I use DeGiro as my online stockbroker. Generally speaking, the online stockbroker that you choose doesn't really matter, so long as you're aware that each stockbroker will have different fees that they charge on different types of purchases that you make using their actual online stock brokerage. And you really just want to make sure that you're choosing the online stockbroker who's going to charge you the lowest fees with respect to the activity that you're going to be carrying out on your own stock brokerage account. You also want to make sure that whichever online stockbroker you choose has some sort of reputable customer services in place in case you have any issues at all with your investments that you need to reach out to someone about. So there you have it. That's my list of 5 key talking points when it comes to stocks that I feel everyone should know at least something about, regardless as to whether you're an experienced investor or a prospective investor in the stock market. Remember, the more time you put into learning about and researching your individual investments as well as the market as a whole, the more comfortable you're going to become with stocks over time. As I've said before in previous videos, the stock market isn't for everyone, but what's important is that you at least give it a try. Start off with a small amount of money invested consistently over a couple of months and see at the end of that period whether or not you can see investments in the stock market being a part of your longer term financial vision. So I really do hope you enjoyed the video here today. If you did like the video and you did learn something, please do let me know in the comments below. Leave a like in the video and subscribe to the channel, and I'll see you in the next one. Cheers.